Hi, everyone. Thank you for dialing in and for making time for this webinar. We had around 300 people register, so we know there's a lot of interest in ESG indices, and I'm going to give folks a little bit of time to continue dialing in. Before we jump into the substance, I wanted to walk through a few housekeeping items. So this webinar is being recorded and it will be posted on our C2ES YouTube page. And because we have so many participants, we're going to use the GoToWebinar control panel for questions. So you can type in your questions online throughout the webinar, and at the end during our discussion session, I'll go ahead and raise them for our panelists. So I'll get us started today by providing an overview of the work that C2ES does, and then I'll introduce the panelists. Pauline Chow will review investor interest in ESG and climate finance, and she'll describe some of the trends we're seeing in the industry. Then Fowle will describe examples of recent ESG index milestones and talk about some of the additional initiatives PRI is working on. Then Skeates will walk us through the different varieties of low carbon indices that are out there. After that, I'll kick off our discussion session by asking the panelists a few questions, and then we'll take audience questions. So with that, let me begin by saying a few words about C2ES. So we are an independent, nonpartisan, nonprofit think tank focused on climate change. And our core mission is to find practical solutions to reduce greenhouse gas emissions, expand clean energy, and strengthen resilience to climate impacts. One of our unique features is that we have a Business Environmental Leadership Council. And as you can see on the slide here, it includes top companies from many sectors, including electric power, manufacturing, transportation, IT, oil and gas, and finance. It's one of the largest U.S.-based group of companies devoted solely to addressing climate change. And one of the benefits of the BELC is that, unlike a trade association, it's multi-sectoral, and so it allows companies to talk to their partners in other sectors about climate policy. And what I have on the screen here is a screenshot of our new website, and I encourage you to take a visit. It's c2es.org. All of our publications are posted on the website, and they are free and available to the public. I also wanted to just say a few words about our Solutions Forum. And this is a program where we bring together businesses, states, and cities to focus on practical climate solutions. We organize public and private roundtables as well as webinars like this one. And we have 3 areas of focus. The first is on employing market-based strategies to reduce carbon emissions. The second is on mobilizing innovative finance for clean energy, efficiency, and other climate-related efforts. And that is why we're gathered here today. And the third focus of the Solutions Forum is strengthening communities' climate resilience. So we want to go ahead and thank our generous sponsor, the JPB Foundation, for making today's conversation possible. And I encourage you to read more about C2ES and our Solutions Forum on the new website, and you can read all of the reports that come out of our Solutions Forum meetings. So now let's go ahead and dive into the focus of today's webinar, which is on ESG indices. We have a lot of great experts with us here today, and Pauline Chow is an associate in JPMorgan Chase's Sustainable Finance Group, which works to integrate sustainability throughout the bank's business and operations. In that capacity, she works with shareholders, NGOs, and employees on ESG matters, and she supports the firm's ESG reporting efforts. Fowle is the head of Americas at PRI, and he manages a team responsible for signatory relationships in North and South America. Before joining PRI, he was the head of investor initiatives at CDP for North America. And Skeates is a senior director for ESG at S&P Dow Jones Indices. Previously, she held a number of senior roles at BlackRock and Barclays Global Investors. Hannah started her career as an emerging markets index fund manager with Barclays Global Investors. So with that, I want to hand it over to Pauline Chow.
Thanks for having me, Fatima, and thanks to everyone for joining today. I'm going to start with a quick overview of ESG and why it's garnering so much interest from investors, and then I'll go into some of the trends that we're seeing in the policy, investment, and corporate space. ESG is broader than just climate, but given the focus of this webinar, I'll probably be concentrating mostly on climate and other environmental sustainability issues. So many of you are probably familiar with ESG, but as a quick reminder, it stands for Environmental, Social, and Governance, and it represents a set of non-financial issues that are viewed as important to the long-term performance of a company. A couple of examples of ESG issues include executive compensation, greenhouse gas emissions, and gender diversity. So broadly speaking, as you can see, these are issues that companies have been paying attention to for a long time. So although grouping these issues under the term ESG may be relatively new, the issues are not necessarily. And what you're seeing now is that investors are increasingly integrating ESG factors into their investment decision process alongside the more traditional financial metrics. And they're doing this really with the perspective that companies that are good at managing ESG risks and opportunities will perform better over the long term. So, in the same way that strong ESG practices could boost performance, poor ESG practices also have the potential to lead to a negative impact on stock price. So what is driving this interest from investors and why now? There are a range of external drivers that have helped shift the way that investors are thinking about long-term profitability. First of all, I'll mention they're getting pressure from governments who increasingly recognize the importance of ESG issues and want to make sure that investors are appropriately considering ESG risks. The case is also being made by research and nonprofit organizations that it's not only a risk but also a significant business opportunity, particularly as younger generations accumulate wealth and look to align their investments with their environmental and social views and priorities. Asset owners are also driving the consideration of longer time horizons, which is causing asset managers to seek out new ways of differentiating themselves on ESG issues. I'd also say that, generally speaking, the view of the role of business in society is shifting, and it's shifting towards the expectation that companies will run their businesses more responsibly and sustainably. So investors recognize this, and they understand that they can have an influence by channeling capital to support positive environmental and social outcomes. And then last but not least, there is more and more research about ESG integration showing that it helps to reduce volatility and increase returns. So all of the factors that I just mentioned are contributing to some of the trends in policy investment in the corporate landscape that we're seeing in the industry today. So in terms of policy, as I just mentioned, governments are either contemplating or enacting policies related to ESG. Typically, the policies aim to either incentivize investors to consider ESG issues in the investments they're making, or they aim to standardize corporate disclosure on ESG. Just to mention a few examples, France currently requires sustainability disclosure and also the disclosure of portfolio carbon footprint for institutional investors. The European Commission established a high-level expert group on sustainable finance, which just published a final report with recommendations to develop a more comprehensive EU strategy on sustainable finance. And so the recommendations that they just made include upgrading disclosure rules and clarifying investor duties to allow them to embrace long-term horizons and sustainability preferences. On the investment side, you're seeing sustainable investing growing, representing a growing portion of total global assets under management. It's estimated that in 2016, the size of the sustainable investing market was worth about $22.9 trillion. That represents an increase of about 25% from 2014. And in 2016, about 45% of that, $22.9 trillion was integrating ESG considerations. So besides ESG integration, which I've touched on a little bit, there are a range of other sustainable investment strategies that investors can use depending on their goals and priorities. Those strategies range from negative screening, where investors will exclude certain companies or industries from their portfolio entirely, to more thematic investing, where they'll make investments based on certain themes or assets related to sustainability. And then investors are also buying green bonds, which are essentially just like a regular bond, but where the use of proceeds are earmarked specifically for green projects. Generally speaking, I would say that we're seeing that investment strategies are getting more sophisticated. And by that, I mean investors are moving beyond just negative screening into deeper data analysis to help them identify companies that are really outperforming on ESG. They're also increasingly using in-house ESG research as a complement to the various ESG rating agencies. And then I'd say this is where the low carbon ESG indices come into play. So essentially, the low carbon indices are designed to reduce exposure to high greenhouse gas emitting companies. And there are a few ways that you can think about how to build a low carbon indice. But typically, they either overweight companies with low carbon emissions or reduce the weighting or exclude carbon intensive companies. Chris and Hannah will go into more detail on indices in a minute, so I'll leave that there for now. The last thing I wanted to mention are the trends we're seeing from the corporate sector. Many companies, including I'm sure many of the companies represented on the phone today, are increasingly considering sustainability risks and opportunities in their business and also engaging regularly with stakeholders on these issues. I mentioned earlier, the shift in the view on the role of business, and I think that this trend is at least in part due to companies responding to stakeholder interest in ESG and sustainability more broadly. On the opportunities side, companies are finding ways to integrate sustainability into the way they do business, whether they're issuing a green bond, developing more sustainable products, or making commitments related to renewable energy or waste management. Here at JPMorgan, for example, we've made commitments to use 100% renewable energy by 2020 and also to facilitate $200 billion in clean financing by 2025. There's also a lot of work happening to promote transparency and disclosure from companies. I'll mention the demand from investors for quality ESG data really means that it's more important than ever for companies to be able to communicate more effectively about their approach and performance on ESG issues. I saw a stat that said that 85% of the world's largest 250 companies are now reporting on ESG issues, and I would imagine that number will continue to increase over time. Related to climate specifically, I also wanted to mention the work of the Financial Stability Board Task Force on climate-related financial disclosures. Over the last 2 years, the task force, which we were a member of, or are a member of, has been working to enhance transparency and improve the consistency of disclosure on climate-related risks and opportunities. So in June of last year, the task force published their final report with their recommendations, and now they're really focused on implementation and adoption of those recommendations. So I think you're going to see a lot of progress in this area. So, all of this is really just to say that there's a lot of momentum coming from many different sides of the ESG equation, especially as it pertains to sustainability. And then from here, I would like to hand it over to Chris.
Thanks very much, Pauline, and to C2ES for organizing. My name is Chris Fowle, and I'm head of the Americas for the UN-supported PRI. And I'm going to walk you through a few slides today. If I could have the next slide, please. And the agenda for myself is to first provide a bit of an overview on PRI, who we are and what we do. But then, as mentioned, I'll be talking about some examples of climate action using indices. And I'll wrap up my comments by talking about some specific company and city actions that are taking place in the broad realm of ESG integration, but related to climate in particular. If I could have the next slide, please. So PRI is a global nonprofit organization. We are an investor-led initiative supported by the United Nations. We work with an international network of signatories, over 1,900 in fact, that include asset owners, investment managers, and service providers, all of whom commit to a set of 6 principles and to putting those principles into practice. Our goals are to understand the investment implications of environmental, social, and governance issues, and to support our signatories in integrating those issues into investment and ownership decisions. The 6 principles were developed by the investors, and as I noted, are supported by the UN. Currently, our signatories represent over $70 trillion in assets under management. And all of our signatories are upholding their fiduciary duty as investors to act in the best long-term interest of their beneficiaries and clients. Broadly, they believe that applying responsible investment practices can help both manage risks, but also potentially lead to better returns while aligning investor behavior with the broader objectives of society. And by implementing the principles, our signatories believe they can contribute to the development of a more sustainable global financial system. Next slide, please. So what are these principles? There are 6, and I'll talk a little bit about how we believe they affect investor behavior. You can find more detailed information on our website. I won't spend too much time here, but in brief, our signatories are committing to first, incorporating ESG factors into their investment processes. Second, being active owners of the companies that they hold. Third, and this gets to Pauline's point around data and disclosure, we ask our signatories to seek disclosure on ESG information from the companies in which they invest. We're also looking for our signatories to promote responsible investment within the broader investment community, and that encompasses both the 4th and the 5th principles, collaboration included there. And then finally, we ask our signatories to report on their activities so that we can maintain a credible standard and continue to affect the reliability of the commitment to being a PRI signatory. So part of the work that PRI does in supporting our signatories relates to specific asset class work. On the next slide, if you'll turn to the next slide, please, you'll see that we've seen tremendous growth in the interest of this support over the last decade. And there have been quite a few catalysts for this. I would say that demand from clients and beneficiaries is paramount among those reasons. The reaction to the financial crisis as well, and a desire to impact positive progress on major world issues like climate change and economic inequality factor in. We've seen investors increasingly understanding the material significance of ESG issues to investment performance, including both the risks and the opportunity side. We believe that investors increasingly understand that ESG is not a barrier, but in fact can help them in better fulfilling their fiduciary obligations to their beneficiaries. And also, increasing this availability of good and consistent ESG data and metrics only serves to improve the inputs to financial modeling. So the momentum for responsible investment has been exceptionally strong in the United States. We're the largest single market in terms of absolute numbers of PRI signatories, where we have 360 across the 3 categories: asset owners, investment managers, and service providers. And both of my fellow speakers on today's webinar are signatories to the PRI. Europe has historically shown great leadership in responsible investing, but the U.S. is growing quickly. On this slide, you can see graphically represented the growth over time and some examples of some of the signatories that we've seen joining in the recent past. So let me now turn, if I could have the next slide, please, to the next section of my comments, which are focused on examples of climate action using indices. Next slide, please. And the first example that I'm going to refer to is the Portfolio Decarbonization Coalition, which the PDC it's a multi-stakeholder initiative that seeks to support and catalyze the transition to a low-carbon economy by encouraging and mobilizing institutional investors to decarbonize their investment portfolios. PDC signatories, the founding members are listed here: Amundi, CDP, my former employer, as well as AP4, a large European pension fund, and the UNEP-FI, one of the UN entities that supports our work and that we work closely with. These founding signatories and now 33 members in total that represent 800 billion in assets have made these high-level commitments to decarbonize. And they've started to implement specific decarbonization strategies across their portfolio, in some cases indices, which I'll talk to. And these actions are enabling the PDC signatories to improve the carbon characteristics of their investment portfolios and funds and to improve, they believe, their investment performance. So signatories to PDC have committed to align their portfolios with a low-carbon economy, and they're sending a strong signal to the market to align investment portfolios, that doing so is doable here and now. And of the members of the PDC, almost all are actually PRI signatories as well, and we work closely with this initiative and support their activities to help reinforce and improve outcomes, broadly speaking, with regard to movement towards a low-carbon economy. Typically, when investors join the PRI, they're doing so to gain the breadth of experience that we help them, that we can support them on in terms of, multiple asset classes and ESG issues. And as they become more advanced over time, they tend to dive deeper into specific issues. And sort of specifically, a lot of our climate work is very well aligned with and helps the PDC in terms of implementing their work. But despite these positive outcomes, there still is limited information on how the portfolio decarbonization efforts of PDC signatories are affecting the real economy, as measured by, for example, changes in greenhouse gas emissions, changes in the greenhouse gas intensity of economic activity, the diversion of financial flows in the real economy, or even changes in the share price of high-emitting or high-impact companies. And I think this reflects a variety of factors. Still, there are relatively few investors that have made portfolio decarbonization commitments, and there's a certain weakness in the objectives that are being set forth still for investor engagement. There's a lack of investor reporting still on the outcomes of shareholder engagement efforts, lack of clarity about the relevance of climate change to investment decision making, and a lack of emphasis on additionality in the decarbonization targets that are being set by investors. All of that said, there are strong examples, especially in the realm of low carbon indices. Amundi, for example, back in 2011, created a strategy for AP4, and later in 2014 created one for the FRR, the Pensions Reserve Fund of France, believing that the technology really does address one of the main obstacles investors face on climate change, in the sense that these are long-term issues that need to be addressed in markets that have a short-term focus, the so-called tragedy of the horizon. And index that encompasses most names as defined within the index has, by definition, a long-term view, so helps stretch the investment horizon to a longer-term view. There are U.S. players that are increasingly working on low-carbon strategies, and I'll talk about one of those here shortly. But I think it's important to understand that before an investor implements a low-carbon strategy, they really do tend to go through a robust decision process around how they're going to address a transition to a low-carbon investment strategy. And inevitably, that does entail some discussion around the options related to divestment versus engagement and how those fit into a low carbon strategy. And so I wanted to take a couple minutes and just talk about divestment versus a low carbon strategy as exemplified by a low carbon strategy. And I'm just going to sort of draw some distinctions between the two that I think will help people, understand those complicated decisions that investors go through when making strategy determination. So first, divestment tends to place the emissions. And let me just define divestment. By divestment, I'm referring to the sale of a particular type of investment. So in public equities, for example, the shares of a company as defined by some particular view, often referred to as a negative screen or an exclusion, a sale, or just an exclusion from an investable universe of a particular type of investment. And in a low carbon sense, often we're talking about oil and gas, and related upstream and downstream providers of services to the oil and gas industry. But my comments really are sort of broadly about divestment versus a low carbon index strategy. And the first point I'll make is that divestment places the emissions responsibilities with the energy producing companies, while an index strategy places the emissions responsibilities with those companies who actually use and burn the fossil fuels. Second, that divestment, only addresses the environmental impact and risk in one sector of the economy, energy. So that's what some might call a static exclusion, just focusing on one sector, whereas an index strategy would tend to address environmental impact and risk in every sector of the economy. So it's more broad and dynamic as a result, and can potentially recognize progress as companies do a better job in decarbonizing, but also recognizes backsliding if they're doing a worse job. Third, that divestment offers clear and simple messaging when you're needing to explain why you're taking a particular step. It's pretty easy to understand when you say divestment that you're selling an investment, while indices are more nuanced, or another way to put it would be that they're more sort of risk aware and maintain the potential for engagement with companies as an active shareholder. Also, there's the potential for significant underperformance or outperformance with divestment if the energy sector lags or beats the broader equity market, whereas with indices, it's a more broad-based approach. You're staying invested in companies, although perhaps with lower weighting, and again, that requires some thoughtful public messaging with regard to why and how you're doing that. And then finally, in divestment, tracking error is usually not targeted. And I'm sure we'll hear more about the term tracking error and its concept a bit later, but tracking error or divergence from the returns of a benchmark is usually not targeted with divestment and may vary uncontrollably over time, while with optimized indices, one would tend to have a low and targeted tracking error. So all that is really background to some of the players in the market. I would say at the advanced stages or at the advanced end of the spectrum of PRI signatories that are thinking about portfolio decarbonization and some of the actions they're taking and why they might be thinking about a low carbon index strategy. Now, if I could turn to the next slide, I want to refer to a specific example. So this example is from the New York State Common Retirement Fund, and it's called the Risk Aware Low Emissions Investing Strategy, or RAIL, the goal of which is to reduce pro rata ownership of carbon dioxide emissions by up to 70% relative to the Russell 1000 policy benchmark. And the way they do that in this strategy is to underweight stock ownership in some of the larger greenhouse gas emitters that are part of the R1000. And just to give you a bit of insight into how this came about, I mentioned New York State, they're part of the PDC. They've been thinking about low carbon strategy, and they worked with one of their providers, Goldman Sachs Asset Management, to develop this strategy going back to January of 2016, when they initially committed $2 billion to the strategy within their broader U.S. equity portfolio. And they subsequently raised that commitment to $4 billion in January, just a couple of months ago. And you might have seen this week that the New York State Common Retirement Fund has just advised a low carbon transition advisory committee that is going to help them amplify their work on low carbon. Overall now they've committed to, well, this extra allocation brings them to, as I understand it, more than $7 billion overall across sustainable investments within their portfolio. But just to reiterate the work they're doing here on this specific index example, the idea, again, they're underweighting stock ownership in the larger greenhouse gas emitters, and that's based on independent emissions data. They actually use CDP data to help them in figuring out which companies to reduce their weighting in. And I'll talk a little bit about what CDP is a little bit later. But the idea is they want to isolate a potential advantage, the low emissions advantage as they see it, that can be scaled up in a risk-managed manner. And they've proved that, you know, the strategy works. They've already achieved some scaling, and my understanding is they intend to do more of that. They believe they're achieving meaningful emissions intensity reduction with a minimal tracking error. Their target is 25 basis points, as I understand. It's a rules-based approach and maintains benchmark awareness, similar to most index strategies. It's consistent with their more generalized approach to passive equity investment. So now let me turn to another example. If I could have the next slide, please. And here I'll refer to Stocks, which is the operator of the Deutsche Börse's index business, who has launched 2 new carbon indices that track the performance of global equities with advanced climate change strategies in place. And here again, they're using the CDP as a source of information, in this case for scores that CDP provides on companies, as a way to screen and weight companies in the index. And in this case, they're actually also excluding certain sectors, including coal, global, and controversial weapons firms. So overall, they believe that this approach may improve the exposure to low carbon factors by using what they see as forward-looking screens instead of relying solely on historical data. So they see the CDP scores as a more forward-looking screen. And then they weight the constituents within the index by market capitalization multiplied by, you know, a company-specific carbon intensity factor that seeks to overweight stocks that have the lower carbon usage. You know, not to say that Stocks is the only index family that has low carbon alternatives. They are one of our signatories, but we have others that similarly provide that. We're going to hear from S&P later as one example. But MSCI also has a global low carbon leaders index family that offers passive investors a substantial reduction in their carbon exposure while replicating the returns of their reference indices. And I think a lot of the service providers that are signatories to PRI have seen a lot of activity happening with regard to demand for products and services that support this type of investment. And more broadly, with regard to rating agencies, we're definitely seeing movement where on the ratings side, so separate from their index businesses, they're becoming more transparent about their ESG activities. PRI actually has an ESG and credit ratings initiative where we're coordinating 130 investors that are signatories to PRI, as well as 14 credit rating agencies globally, so both the big players and many of the regional players, on activities that are related to enhancing the transparent and systematic integration of ESG factors in credit risk analysis. And so point being that a lot of the service providers, both on the index side and on the ratings side, are doing a lot more these days with regard to ESG. But let me turn to specific segments of the investor community, if I could have the next slide, and talk a little bit about both company and city action. First, on the company side, This slide 11 is the next slide, please, is a representation of a survey that Natixis did in 2016 of DC, or defined contribution plan participants, where they were looking for feedback on what stakeholders or plan participants, so 401k holders at different companies, feel about investments in general, and how they reflect their personal values. And you'll see across these various segments that none of the responses were less than 50%, and that overall there seems to be a strong interest across segments for E&S activities, the records of companies that they invest in, that the constituents want to see more socially responsible investments in their retirement plan offerings, and that they'd be likely to contribute and increase their contributions to retirement plans if they knew that they were doing social good as well. So next slide, please. If a company wants to think about, or wants to start thinking about how to do that, potentially including plans that incorporate climate-aware indices, here are some practical steps that one could start to think about. And we actually did a report with our other UN entity partner, UN Global Compact, around aligning values. A screenshot of the report is here. Why corporate pension plans should mirror their sponsors. It addresses sort of traditional pension plans, but also a bit of information around DC, or defined contribution 401k plans as we know them, those that are governed by ERISA. And some of the ideas would be to start conversations within governing bodies and corporate sponsors on the benefits of responsible investment, to seek feedback from the beneficiaries on their attitude to responsible investment, much like Natixis did in this survey, to begin conversations with service providers on their approaches to ESG integration. So that could include 401k platform service providers, but then also the investment managers, funds that are offered on those platforms. Access resources and training to raise the level of awareness of responsible investment on the plan governing body, and then of course signing up to the PRI. And on the next slide, please, you'll see that there are a couple of examples now of U.S. corporate on the one hand, Bloomberg, and then also Unilever, examples of companies that have signed up their 401k plans as signatories, and there are other examples outside the U.S. as well, of corporates that have become PRI signatories with more traditional defined benefit plans. And there, some of the things that they're thinking about in terms of ESG integration and how to get started would be, incorporating ESG issues into investment policy statements or investment principles, expanding the fiduciary training for trustees or governing body members to encompass ESG issues, communicating to investment managers that ESG is important to the provider and to the fund, and adding ESG integration into the selection, appointment, and monitoring of managers, engaging with fund constituents and or voting proxies, and then of course exploring and conducting carbon footprinting, tracking, or other analysis, which could then lead to further low carbon index strategies being implemented. And now I'll briefly turn to, on the next slide, some activities that we're seeing from cities with regard to connecting their operations and their investments. We have some examples in the U.S. where U.S. city-affiliated pension plans have become signatories to the PRI, including San Francisco, Seattle, and New York City. And increasingly, we're seeing investment strategies in municipal fixed income being offered from some of the PRI signatories, including folks like TIAA, Standish, Breckenridge, Girton, and others, recognizing that municipal credit risk and ESG dovetail nicely because many of the cities are doing so much in terms of their operations. We also see green bond issuance increasing and more cities reporting on their sustainability efforts. CDP, in fact, provides a global platform for cities to report, and I understand that more than 500 are now doing so. So there's a lot of environmental focused data available for investors to use and for cities to promote in terms of their activities. On the green bond issuance side, we've seen more than $155 billion of issuance last year, which represents 78% growth year on year. And the U.S. is the largest single market now with $10 $10.7 billion of issuance. And we've seen more cities thinking about, including their retirement plans or their treasuries in terms of adopting sustainable investment. One example on the next slide is Chicago, who just in the last week or so announced they intend to become a responsible investor. And the relevant quote here is that from the Wall Street Journal article is that local governments in the U.S. are in the early stages of determining how much weight to give to ESG factors, which can be broadly defined and hard to measure. Fair enough. Many public officials are also struggling to determine which social issues, from diversity to gun control, their municipalities should embrace, and how to express those stances through investments of taxpayer dollars. And then on the next slide, you'll see kind of what City of Chicago's Treasury is thinking about and what their approach is going to entail. So they're thinking about 100% integration across ESG, and here are some of the factors they're thinking about in that regard. And then they do intend to make this a comprehensive approach, which for them means to seek and maintain a minimum ESG portfolio rating of investment grade or higher, making Chicago the first city in the world, they believe, to adopt a minimum ESG portfolio rating for holdings of corporate securities. They do want to be proactive in their approach, and they will be making a commitment to PRI. And finally, they want to be carbon neutral. So here again, reflecting what they're doing on the operations side in their investment portfolio to help further progress. So the rest of my comments, if I could have the next slide, please, are really meant as a reference for yourselves, and I'm sure the slides will be available after the webinar. Next slide, please. The first is just a bit of a description of what PRI does and how we support our signatories across the various teams. I'd be happy offline to talk more about that if folks have interest. And then my last slide, the next slide, please, just an indication of how to stay informed about all of the support that we provide for our signatory base online. So thanks very much, and I'll now turn it over to the next speaker, Hannah Skeates of S&P Dow Jones Indices. Thank you.
Hey, thanks very much. Thanks, everybody. So I have a number of slides here that I'm going to run through, hopefully not too slowly, fairly quickly, that cover some of the points that we've talked about the drivers, and then we'll go on a little bit more into examples of the indices that we have and the things that can be done. So if we flip forward just a couple of slides here, what can we do and how can it be used? Well, if we see on the next slide, we create indices for, generally speaking, the purpose of measuring the performance of markets. That's sort of the fundamental original rationale for indices. And more recently, they're used as the basis of the creation of passive financial products, and that's a lot of the things that have been discussed already today. So things like index funds, exchange-traded funds. And they're used sort of across a number of different parties. We have the market intermediaries like the investment banks, the investment managers, wealth managers, who are doing a lot of the creation of the actual financial product. And then the drivers behind that are obviously the asset owners, so the people whose investments they're working on behalf of, and the pension plans and the government funds. And as we've heard this morning, a lot of this drive is coming from the asset owners, who are thinking about different ways that they can implement some of these ESG, sustainable, climate-related topics within their investments, and then working with the banks and the investment managers to implement those. And as index providers, we are sort of taking all the capabilities that are out there and helping to construct new indices that can be used for these purposes. So if we flip forward a couple of slides now, as we were hearing from Pauline, what's changing? Well, on the next slide, you'll see there's the conversations coming from so many different angles that are helping to forward this movement. The World Economic Forum, every year it produces a risk landscape, a global risk landscape, and you see on this slide so many more climate-related risks that are getting further and further up the impact and likelihood scale, things like water crises, natural disasters, extreme weather events, and failure of adaptation to these topics. On the next slide, as an example, things like physical risk are becoming more obvious. Unfortunately, some of the climate risks that were more theoretical in the past are becoming more physically obvious, and understanding that certain amounts of, whether it be real estate, infrastructure, could be below sea level, the type of significant weather events that we're seeing on a more frequent basis, and then the losses related to that, whether it be sort of insurance-related losses or otherwise, or the impact on the cost of premiums going up. All of these things are becoming more obvious in our kind of everyday lives. So on the next slide, one of the things that becomes a big topic is really about the short-term versus long-term perspective on this. And if you think about assets and companies and how they're valued, they've been valued on the basis of growth and discount rate assumptions, and not necessarily on explicit forecasts. And this diagram sort of shows how far out you would need to look to see some of this value of different types of companies realized. And McKinsey has shown, with the Carbon Trust, has shown that more than 50% of the value of an oil and gas company, for instance, is related to what could be generated really quite a long way out into the future, so 10, 11 years onwards, from year 11 onwards. And if we look on the next slide, you may have heard this concept of stranded assets and unburnable carbon. And if we think again about the value of companies and how they're thought about, if, as all the countries have agreed to through the Paris Agreement, we need to commit to an amount of carbon, a certain amount of carbon being burnt in order to get us to that 2-degree limit, then there is a certain amount of these fossil fuels that actually physically can be burnt before we hit these limits. And therefore the question being, even if these reserves exist, whether or not they are tangibly burnable in the future, and therefore are those assets stranded or not. So it's with these concepts in the background that on the next slide we see very significant figures within the finance industry, like the Governor of the Bank of England, Mark Carney, a couple of years ago, really starting to elevate this topic up the mainstream agenda. So, we're not talking here necessarily about niche elements of the investment community, but very much front and center, talking about this horizons issue and how far out we're looking. And, he's quoted in one of his speeches as saying that the past is not a prologue, and the catastrophic norms of the future can be seen in the tail risks of today. The interest here being obviously that if we have to make significant changes as a global economy, that it would be better for all concerned that those changes were predictable and smooth as opposed to disjointed as we go through the transition. On the next slide, Pauline mentioned the Financial Stability Board's task force on climate-related financial disclosures, and that was driven obviously by Mark Carney and the FSB. Michael Bloomberg chaired it, and the recommendations that came out of that were multifaceted and covered a number of different companies, and is an example of this type of topic now being again pushed into the mainstream, pushed into requirements or recommendations for requirements that are suggested across all different types of sectors, and allowing investors, allowing those that are in the middle of the, creating the marketplace to understand topics that they maybe didn't understand in depth before, and certainly not, maybe had access on a regular day-to-day basis. The follow-on from this, as we heard previously as well on the next slide, was with the European Commission and the EU setting up a high-level expert group. As Pauline said, they came out with a set of interim recommendations and then their final report. And very recently, we've seen the Commission's action plan on sustainable finance. And this really is quite a significant move for the industry, for the region, and potentially with global ramifications because of everybody sort of watching to see how this goes. And what you see within this is a lot of the recommendations that relate to disclosure, to understanding, but it goes beyond that as well. So it's things like disclosure and classification systems, but then also more far-reaching into fiduciary duty, looking at potentially all financial legislation that gets passed in the EU and making sure that sustainability is considered in that. And then things like infrastructure and to the question of the transition and how do you move to a low carbon economy, making sure that all these pieces that maybe were sort of fragmented in the past are pulled together through this overall planning process and executed and through things like the European supervisory agencies as well. So this is the momentum that was mentioned. All of these things are sort of following on from each other and creating more and more of a ripple effect through the industry. And what we see as how we can evolve on the sort of provider side, if you flip forward a couple of slides now. On the provider side, we have new ways of taking these concepts and integrating this information into indices and other things. So what we're able to do is, this slide is an example of some of the ESG indices that we have at S&P Dow Jones Indices. And what we have tried to lay out here for the purposes of the marketplace, this is by no means all of our indices, but examples of some of them, we tried to lay out in the way that they can be used by different investor types, because different investor types, as we previously heard as well, are trying to solve for different requirements and different solutions. And I completely agree with Chris on his comment about the consideration of options that are available to investors and making those significant decisions and thinking about which aspects of this topic they want to integrate from their point of view. And so from the perspective of an index provider, what we can do is we can create various different flavors of these that will fit with whatever it is that a client or an investor is looking to do. So this categorization here sort of splits between integration. We mentioned here ESG, but there are conversations that occur about ESG in general, with environmental, social, and governance all bundled together. And then sort of slightly separately, conversations about carbon. And we do see that people increasingly can make decisions on ESG and decisions on carbon, but will take their carbon decisions somewhat separately and may set particular targets and objectives for the carbon piece. So we have sort of what we're calling core ESG, which looks and feels a lot like sort of the original indices that they may previously have been benchmarked to or invested passively alongside, and take these topics and try and integrate them in a relatively straightforward fashion. There are then other investors that have made much more specific decisions about the types of things that are important to them, what they're trying to achieve. Perhaps they have particular passive factor investments, and they're trying to overlay a low carbon approach to those factor investments, or are looking at very specific topics and want to integrate all those things together. So there are lots of different ways. And you write an index methodology, there's lots of flexibility to incorporate different elements into that index methodology, and to either tilt or to exclude or to target in different ways. And the process of an index methodology is that all those things are written down very specifically, and the index follows the rules of the methodology. So beyond the sort of the two top categories here, we have other categories which, if I suggest that the top ones maybe are looking more at the risk side of the equation. They're saying, have I incorporated environmental risk, social risk, governance risk, and considerations of carbon, potential carbon risk, carbon pricing risk. We see, and it relates to the idea of maybe more millennials, more women being interested in the topic. How do you, can we also have more thematic ways of investing? So can you identify and create indices which will track the performance of certain topics? And Clean energy is clearly one of those topics. Water is a topic. We heard about green bonds. We set up a couple of green bond indices to track the performance of both that market and a sort of more tradable, smaller portion. And then increasingly, we're having conversations about innovations in the climate market, which can be things like pathways to the 2-degree alignment. And if you're looking at the energy portion of an index, or in fact any portion of an index from a sector perspective, to what extent are the companies that are contained within that sector making progress towards 2-degree alignment? And so the idea of having more data available to input to indices really is one of the things that helps us drive the ability and the capabilities to produce more products. On the next slide, I just wanted to give a quick example of the types of things that can be integrated, so you get a level of sort of granularity here. This is more on the ESG general side. This is we work with a company called Kazam, who are well renowned for their ESG capabilities in looking into the detail of companies and what they're doing from an ESG perspective and the sustainability point of view. And you can look at companies on a sector basis. This is a mining industry example, and say from a social point of view on the mining industry, what are the types of things that can be looked at and assessed? So it's everything from their social reporting, their human rights practices, their occupational health and safety, and also how they are impacting communities and taking the ability to understand what they're doing and integrating that into a kind of overall scoring mechanism. So that's kind of an example on the social side of a particular industry. On the next slide, if we focus more on the climate, S&P Dow Jones Indices acquired Trucost, the environmental data expert company, a year or so ago. And Trucost is a environmental data experts. They look at it from a very quantitative perspective. They're gathering data on emissions, production of various fossil fuel outputs, water, waste, air pollutants, land pollutants of various different sorts, and are able to model that information in the absence of companies actually disclosing the information as well. And so what we're able to do now is look at lots of different angles, both from a sort of footprinting and management, green brown, so that's sort of renewables versus a fossil fuel, and these, as I said, the energy alignment, the 2-degree energy alignment, gives us increasing areas of information which can be used to drive index methodologies and decisions about what investors want to do. So if we just flick to the next slide now, thank you. What we've done here at S&P Dow Jones Indices is say, well, as we have this information available to us, we'd like to start to put that type of information as standard onto all of our indices where we have enough information. And so as opposed to keeping this purely within a sort of ESG indices segment and a certain area, the idea here really is to say, well, these metrics can be applied to absolutely everything. Why not start that process of education and familiarity by taking those numbers, taking the calculations, and putting them on all indices? And I think this is an analogy here is sort of with calories. You start out, you maybe don't know what the number means, but you start to see it on more things. You see what is a bigger number or a smaller number, and eventually you get to a point of view on what a target might be and what you might be aiming for. And so on this slide, what we're showing is that if you pull up our website and pull up one of the indices on our website, we have very sort of normal standard metrics on performance and the constituents, sector breakdowns, and now we've started to put these 5 different carbon metrics on the majority of our equity indices, just so that we can help to build this familiarity. And there are different types of carbon metrics, and again, this is something where a large part of our community is sort of learning a new language, understanding that they're isn't just one way of looking at these things, and you actually have to become sort of more educated in the multifaceted ways of looking at the topic. And to that extent, on the next slide, what we did was we produced a carbon scorecard, and this was really to illustrate the point of view that there are different ways of looking at the carbon numbers, to show various different headline indices covering equities from different parts of the world. And to show on the slide what you see, the green is the kind of lower impact, so more climate friendly, let's say, and the darker blues are the higher, more sort of fossil fuel type impacts. And to say, carbon footprinting is very much a measure of emissions in the past year, so sort of right here, right now. Some of the other metrics are looking more into the future about fossil fuel reserves or coal exposure, or this idea of whether or not the energy portions of an index are split between fossil fuel or renewables, and to what extent could that be changing. And so what you see is some of these colors change quite significantly depending on whether you're looking at right now or out into the future. And again, this is about sort of building background information such that investors can become more familiar and get to that point of trying to make a decision on what it is that they would or would not like to do. When we launched this, we went back to our carbon indices that we actually have had live now since 2009. So actually for a very long time, we've had a number of low carbon indices. And on the next slide, when we were showing the scorecard, what we wanted to say was, well, if this understanding of what you have in these various indices drives you to think about what the other alternatives are, then here's some indices that show different ways of incorporating carbon, as we heard earlier, whether it's sort of tilting or excluding fossil fuels, and just to show the performance, how those have performed over the past, well, this slide goes back to 2012, but sort of over the past 8 or 9 years or so, and actually these have all outperformed the basic S&P 500. So just to change gears slightly, on the next slide, if what we've previously discussed are ways of incorporating and thinking about carbon risk and climate risk, we understand as well that a significant shift has to happen in global economies and through things like the UN Sustainable Development Goals and other initiatives. The significant shift in capital that is required to occur if we're going to be successful in this move is, well, here it's quoted as sort of $93 trillion. There's very large amounts of money being required, and these are in topics such as clean energy, sustainable agriculture, water efficiency, low carbon transport, smart technology, and waste reduction and waste management practices. And this can be viewed as an opportunity, as we have more discussions with investors about what they're looking to do and how they're looking to target their investments and ways that, ways they can do potentially sort of passive management of some of that. Perhaps on the positive side, or the positive targeted investment side, there's increasing interest in these more sort of thematic topics and indices that can be created to target and home in on some of these very specific opportunities in the future. And then very quickly, I'd just like to give a couple of examples of some of the indices that we have so that you get a quicker overview. On the next slide, we have the Clean Energy Index, the S&P Global Clean Energy Index. What this is doing is it's looking at clean energy producers and clean energy technology and equipment providers. You see on the slide some of the specifics of the types of things we're looking for there. And then obviously not all companies are pure play in this area. And so we look at including index rules that will weight these companies or score these companies on the basis of whether or not it's their primary business. On the next slide is the map of the S&P Green Bond Index. This is the very broad based index, which is intended to just measure the full scale of this market now. As Chris mentioned, you see that the US is sort of dark green there, and that indeed the majority of the biggest exposure in that index at the moment is coming from the US. But again, it's quite spread across the globe. You know, the way indices tend to evolve is that over time people like to split and have the ability to look at things from a regional perspective or a currency perspective, and I'm sure in the future, as this market gets bigger, we'll have the ability to slice and dice it into more portions. But at the moment, we tend to look at it on a global basis, given the sort of nascent element of the market. So, just finally, on my final slide, just in summary, really, you know, S&P is based across the globe. I'm fortunate enough to have conversations with all investor types across all regions. And whereas in the past you might have said that different regions were looking at this topic in different ways, it feels now that actually, especially with the focus on climate, we're having sort of more or less the same conversation across the globe. It might just be that certain investors or asset owners are sort of further down that conversation and further through their decision-making process about how they'd like to address it than others. But I do think that there is increasingly a similarity in the way that the topic is being addressed, which is, I think, encouraging for all of us given the topic of today. Thanks very much.
Great. Thank you so much for that presentation. I feel like we've all learned a lot about the space here, and I wanted to just jump right into a discussion session. And I have some questions on the slide. Feel free to type in your questions in the question box if you want to ask any particular questions. So let me start with the first one, and this is for all of the panelists. Could you discuss the connection between ESG indices and investor engagement with companies?
Yeah, sure. This is Chris. I'm happy to jump in and start the discussion around that. You know, it's interesting because some people would assume that, you know, if someone's a passive investor, so investing via an index, that they're not a direct holder of a company and therefore wouldn't have any reason or basis for engaging directly with the company. And in fact, what we've seen many investors evolve to is the fact, you know, is that given they are a universal holder, you know, if they're using a broad-based index approach, that it's incumbent upon them to engage with as many companies as possible. Of course, practically speaking, that may or may not be possible, depending on the amount of resources they have, et cetera. And in some cases, what we've seen is then a more focused approach in terms of engagement. So one quick example would be CalPERS, having engaged in exercise of portfolio carbon footprinting a couple years ago in response to PRI's so-called Montreal Pledge, i.e. a commitment to be doing a portfolio carbon footprint. CalPERS realized that there were about 100 companies in their portfolio that had the largest impact from a carbon intensity perspective, and they decided to create an engagement around that and open it up to the broader market. And so, you know, now you're seeing quite a few investors working collaboratively to engage with these 100 companies. And so, and there are other examples of both individual and collaborative engagement from passive or index-focused investors. And so, I don't think that they're mutually exclusive, certainly, and more investors are getting interested in doing both. In fact, PRI's got a work stream now where we're specifically focused on passive investment and providing some guidance to our signatories, and over the next several months we'll be issuing the first piece of a report, so really the first piece of our guidance for passive investors.
Thank you. This is Pauline. I'm happy to chime in and give the perspective kind of from the company side, and, you know, broadly speaking about ESG, not necessarily specific to indices, but JPMorgan engages with our shareholders and investors on a regular basis. it's something that my team works really closely with our investor relations team on a regular basis. It's also, we've integrated ESG into our regular shareholder outreach process. And I think from our perspective, it's really, the engagement is really valuable, not only because it allows us to communicate about our efforts, but it also allows us to get a better understanding of how investors are thinking about these issues. So I think in general, as ESG continues to gain attention from investors, whether it's through indices or otherwise, I think direct engagement will continue to be really important.
Thank you. That was a really good perspective. The second question is about the significance of an investor's time horizon for considering ESG issues, including climate change.
Yeah, from the PRI's perspective, this is a fundamental piece of the puzzle. Many investors have long-term obligations. If they're a public pension fund, in particular, they've made promises, right, to their constituents, their beneficiaries, over a very long period of time. But the financial markets do tend still to operate on a short-term horizon. We've seen a lot of great work, including the FCLT, which is a nonprofit called Focusing Capital on the Long Term, that's specifically addressing this phenomena. And then, PRI, as well as part of our 10-year strategy, is trying to help folks figure out how to sort of change that dynamic and how to come up with some practical recommendations on that front. But as both, I think, myself and Hannah mentioned, there's this sort of tragedy of the horizons where you've got a long-term investor, which is almost part of being a passive investor. You're in the market. You've made a commitment to passive investing or index-based investing. You're doing it over the long term as a result. And so, how do you fundamentally manage the dichotomy between those two things? So it's fundamental. It's important. I think it's changing slowly, and the increasing amount of higher quality data that can help feed into these very practical decisions that investors need to make in the relatively shorter time frame, I think will become more and more mainstream going forward.
Thank you. And that kind of leads us, sorry, go ahead.
No, I was just going to say, just to add to that, as Chris mentioned, the Focusing Capital on the Long-Term initiative, one of the things that we looked at in conjunction with a number of those parties involved was the creation of the Long-Term Value Creation Index. And the background to that was the idea that the investors who were looking into the long term wanted to look at things like governance in particular, and companies that the belief that companies that were well governed would be important as you look further out. And as we work with them on the creation of an index on that topic, one of the kind of methodology changes that we introduced was actually where indices sort of normally rebalance regularly and kind of you can have potential turnover of the constituents, was to introduce a concept where the constituents of the index could actually stay in the index for longer and sort of reduce the speed at which that turnover could occur in order to kind of focus on that slightly longer term point of view as well. So there are things that you can do on a technical basis to try and be more creative around the topic too.
Thank you. This kind of leads us into the third question, which is, what are some of the data quality challenges related to ESG?
I'm happy to start us off. As I mentioned earlier, I used to work at CDP, formerly known as the Carbon Disclosure Project, which asks cities and companies to respond to an annual questionnaire. And because that disclosure is voluntary, not regulated in most cases, the amount of information, the quality of the information as to whether it's audited, et cetera, is by definition inconsistent across companies, and that can lead to issues when one wants to use that information for decisions. So there's and it's extremely important that investors continue to engage with investee companies to require that they disclose, and that's consistent with Principle 2 of being a PRI signatory, Principle 3, looking for disclosure from investee companies. And I think slowly over time, the data quality, breadth available, and the quality of the information has increased. But I think most market participants would agree there's still a lot of room for improvement.
Yeah, I'd agree. And what I would...
I was just going to encourage folks to be on mute if they're not speaking.
So I agree with Chris, and what I'd add is, in addition to just the quality of the data that exists, there are also a variety of challenges just with the comparability of ESG data. It's something that we've experienced and also heard from investors about. But I'd say, there are challenges in determining what's really decision useful for investors. Even within the same industry, there can be issues that are material for one company and that may be slightly different for another. So I think there needs to be a balance that's sometimes hard to strike, so that it's not just disclosure for disclosure's sake. And I think, while the need for consistency and comparability exists, there also needs to be a flexibility for companies to determine on their own how and what to disclose based on the nature of their business. So, I think it's a complicated issue. Certainly we don't have all the answers, but it's definitely, I think, something that everyone's thinking about and grappling with.
I would just add, just slightly on the slightly positive side of this, obviously, you look back a few years, 10, 15 years, and there was, close to nothing here. It's one of the reasons why my colleagues in Trucost existed, to kind of model this information in the absence of anything being out there, and to kind of help work on the international standards and put in place the types of things that you would expect in sort of more regular, more mature financial markets. And over the past 10, 15 years or so, we've seen, obviously significant leaps and bounds in the ability to have these standards and protocols in place, the ability to test against the models if you model the information to start with, and then, check back with the companies themselves. And it has been a learning process, definitely, for a number of companies who, maybe haven't done this many times, and get better and better at it year on year. And I think as a community, we have to, work towards, it's beholden on us to kind of work towards this getting better. But certainly the big initiatives that we've all mentioned are helping to drive that forward now in a kind of slightly more light speed fashion. So I have no doubt that we're going in one direction here, and it will only get better and better.
Yeah, it's probably worth mentioning SASB in that context, the Sustainable Accounting Standards Board. I used to sit on their advisory committee as they were working through their initial attempts at creating, material indicators by sector, and I think that is very useful, especially for mainstream investors that may not be familiar with the ESG space, because it gives them something to relate to, a relatively limited set of predominantly quantitative but also qualitative indicators by sector that through a robust feedback process have been determined to be material by sector. So it's a good sort of jumping off point for folks to think about these issues and start incorporating them into their investment processes.
Thank you. We definitely have a lot of audience questions coming in, and I just want to touch on the last question on the slide before we turn to those. And the question is, some investors are using ESG indices as reference benchmarks, and some of the examples include Swiss Re, New Zealand Super, and Allianz. Do you think more investors will start to use ESG indices as reference benchmarks?
I mean, as I kind of stated at the beginning of my presentation, there's lots of different players in the market, and they use indices for various different reasons. I think you're referring to some there that are using it as sort of as strategic or performance-related benchmarks. But this conversation is starting to come up more and more, and there are definitely different points of view on the topic. You can talk with active fund managers who are looking to have a benchmark that they can be compared against for the purposes of seeing how their active performance has done. In some cases, they believe that it should be the type of universe in which they invest, which is already directly related to, if they are a sustainable investor, to sustainability or low carbon. In others, they may argue that actually they're a sort of general global, let's say, for example, a global equities investment manager, but they believe that investing in sustainability is good business, and therefore for them they would much rather have a more general global equities type benchmark. So there are different reasons why you would or would not from a performance point of view, but to your question, is it happening more? It's definitely, it's gone from close to nothing to something, so it's definitely picking up.
Okay, great. So here's one question that came in from the audience, and it's about the fact that there are low carbon indices, and carbon seems easier to index because it is more measurable and you can compare. Whereas if you look at something like adaptation to climate change, the adaptation value or the avoided cost, that's harder to measure. But does it seem like there might be a possibility for resilient investment indices down the road?
I mean, I think you'd have to speak with your, maybe it's a question for sort of Pauline and Chris about what it is that the investor is trying to achieve. As I said, indices are based on inputs and rules and methodologies, and therefore, there's lots of potential for creating lots of variance. And we certainly have conversations now about sort of 2-degree alignment. I think the question of resilience really is, what do you mean by resilience? And we would sort of need to understand the detail behind the term resilient and the assumptions that had gone into that to understand what were the right things to create within it. I don't know if Chris or Pauline wants to add anything.
Yeah, I mean, from my perspective at PRI, when we find, areas of interest from our signatories, often one of the best ways to help get to that definition, as Hannah suggests, would be to work collectively with some of the thought leaders in the space to start, driving that determination forward. So we'll bring together those with expertise or outside experts to help start driving it forward. I know that the IDP runs a group called Pro-Adapt, where there are quite a few investors already working in the Latin American region in particular on these issues and thinking in depth on what adaptation looks like. And as part of that effort, they do have an index that helps measure some of the progress of companies. It's not an investable index per se. It's an index, quote unquote, that provides a view on a relative basis of where companies are in thinking about adaptation, and they do regular convenings on the topic. So there has been work done in the field, but in terms of translating that into an investable index, you would definitely need to agree definitions and data sources.
Great, thank you. That was helpful. So there's a question about that kind of follows up on what Chris was talking about in terms of divestment. And the question is, if most of the world divests from a stock, wouldn't that just drive the price down and actually make it more attractive to less ethical investors, in the end, maintaining the price equilibrium?
Yeah, it's a great point. And in fact, I think a lot of academic research on divestment, broadly speaking, going back to, in particular, apartheid-related South African company divestment, et cetera, I think has shown that it doesn't necessarily have an impact from a price perspective, because especially now where you've got high-frequency trading and other market mechanisms that allow people to buy on different types of market signals that might have no relation to ESG factors, you may not see a so-called permanent impact on a share price. But the act of divesting in and of itself does provide a signal to the marketplace and can potentially change behaviors. I think that's been relatively marked in certain parts of the U.S. investing universe. In particular, I would note university endowments or public pension funds that are subject to political processes have been, at a minimum, forced to consider divestment as an option and articulate why they agree or don't agree with it and what they might be doing as an alternative. San Francisco Employee Retirement System, who recently became a PRI signatory, went through just such a process and ended up with a kind of middle ground approach. And New York State, the example that I had earlier, uses passive indices, but then they also work very heavily on engagement, and in some cases may be considering divestment going forward as well. So a blended approach. But yeah, the point is well taken that it may not have a permanent impact on a share price.
Just to add to that on your changing behaviors point, I mean, one of the things that is becoming more apparent, I think, at the moment is the number of announcements that we see that seem more like a conversation about a technology change. You know, the fact that there are lots of announcements at the moment about from the auto companies on electric vehicle commitments and technology changes in that direction too. And so I think that then can often become quite a sort of familiar feeling to the regular investment markets that something is changing and there will be a new technology in the future and an old technology of the past. And so I think, you know, it's a complex social and technological conversation as well.
Thank you. Yeah, and then this probably will be our last question, but kind of following up on that in terms of the changes that we see happening. One question from the audience is, how often is a specific metric updated on a stock? How manual or how automated is the data collection?
So generally speaking, if you're looking at sort of carbon-related things, you're looking to find numbers that are disclosed, which tend to be disclosed in things like annual reports or corporate sustainability reports or other types of reports which tend to come out annually. And there's an element of sort of looking through those and trying to find the right number. You know, if you're doing it on a modeling basis, you'd sort of want to keep it in consistent with that as well. And so an annual basis makes sense on that point of view. Automated is tricky at the moment, just because you have to make sure that you're taking account of all the potential nuances in how something is being reported, especially as this is, you know, we're not at the stage yet where there are necessarily required standards in ways that people do report this. So you want to make sure that what you're looking at is consistent across the board. It's, you know, all of the operations, it's not for a portion of them, that type of thing. And so, you know, while I can envisage a point in the future where you would maybe be able to scrape that information, at the moment, I think you have to spend more time making sure that you know what you're getting.
Great, thank you. That's super helpful. Well, great. I think we will have to end our conversation here. As a reminder, we will be posting the recording of this webinar on our C2ES YouTube page, so I encourage you to look for that. And we will also be having more finance webinars soon, including one on Monday on climate scenarios. So I encourage you to check that out. We've been talking a little bit about the Task Force on Climate-Related Financial Disclosures, and that will be part of the conversation. So again, I thank you for making time for this webinar. Thank you to our wonderful panelists, and I hope you have a good rest of the day. Thank you.